stop chasing. Okay, listen, in this video, I'm going to show you guys exactly how to avoid staying in trades too long, right? I'm going to show you how to determine which targets you need to shoot for when in a trade. Now, if you can understand how much capital to risk based off of your capital, right? You understand where you're getting out to take profits, then you never have to worry about a thing when you're in a trade. All right. A lot of times people are in trades and they're stressed out. It can ruin their day if things are not currently going their way. And I want to show you how to essentially be a Zen trader by understanding the levels in which you're going to take profit, also understanding what the trade's going to look like if it works out in your favor and if it doesn't. All right. So let's get into it. But before I do, make sure you hit that like button on top of me. All right. Hit the subscribe button so you never miss another value packed video. And let's get into it. Now, before we get into the charts, there are three things that I use to find my targets, right? There's fair value gaps, there's order blocks, and then there's liquidity. All right. These three things are going to allow you to determine when and where to fold them. All right. When and where to get out. When and where to cut your greed off. Before we deep dive into the charts, I think it's really important to just make sure that we have a fundamental understanding of what these terms are. Okay, so a fair value gap is a price imbalance where the market moves so fast that the trading skipped over the price range. Okay, this takes place in a 3-candle sequence. All right, a fair value gap exists when the high of one candle and the low of the 3-candle do not overlap. It leaves a little gap in the price delivery. All right, so in simple terms, the price moved so aggressively that buyers and sellers didn't transact efficiently in that area, which is why we usually call that gap an area of inefficiency. Okay? Now, an order block is the last opposing candle before a strong institutional move that breaks market structure. All right, an order block is the final bullish or bearish candle before a large impulsive move that causes a break of structure. Now, these order blocks can be placed on your chart by using the indicator Lux Algo, okay, order block detector by Lux Algo. It makes it a lot easier for you to locate without having to do it yourself, right? The same with fair value gaps. You can use fair value gap by Nephew Sam, all right? And last but not least, liquidity refers to a clusters of stop losses or pending orders in the market. All right, these are areas where large players can execute big trades. Now, liquidity is a concentration of buy or sell orders sitting at predictable levels in the market. Markets tend to move toward liquidity. This is very important. All right, now some common liquidity areas are equal highs, right? Equal lows, previous day highs, previous day lows, swing highs, swing lows, and trend levels. All right, so let's look at an example on Microsoft, right? So currently, Microsoft is in a short-term bullish uptrend. It just recently broke out of this bearish trend that's been taking place for quite some time. All right, so I have the trend line drawn right here. And as you can see, there is a fair value gap right here. Now, we entered into Microsoft down here, and then it made its way up here to fill this bearish fair value gap that was created on the way down by way of inefficiencies in 3 candlestick pattern sequences. Okay, like we discussed when giving the the definition for fair value gaps. Okay, so this right here is considered a fair value gap because this wick right here on the 1 candle, and then this wick right here on the 3 candle, this middle candle right here being the 2 candle. Okay, so the gap has been formed right here. Now, as you can see, we took the trade when it broke out of this downtrend, and then we rode it up and took profit up here at the gap fill, right? Now, fair value gaps are important places to take profit because it's at that point that a decision is being made. So as you can see, this candle right here went and tested the fair value gap and it pushed down. The next candle, still following this uptrend, went up, straight back up into the fair value gap, and it tested it, and then that next day it started to fail a little bit. Now this still may continue to the upside, right? Because it is in a strong uptrend, but you'll notice how there was 1, 2, 3 days where there was a fight to get above a fair value gap. Now, if you're in a trade and that fair value gap gets filled, right, it gets breached and then it starts to get filled, it makes sense to, at the end of it, or even 50% of the way through the fair value gap, to take profit, right? That's important because, like I said, decisions are being made there, right? The fair value gap is typically going to get closed, but 50% of the fair value gap gives you a much better chance to avoid any sort of traffic, okay? So say you're in a weekly contract and it's like Tuesday. You may want to get out halfway through the fair value gap right here at this level so that you don't have to fight with it the next couple of days, right? You'll still have decent profit if you entered at an entry point like the break of this candle right here. So taking profit right at 50% would just be easy instead of giving you the headache of this. Now, the next entry for getting into this would be the break of the fair value gap, and then the next target would be up to the beginning of the fair value gap. Okay, so there's a few ways to play fair value gaps. You can take profit from a point of, a break of a structure headed to the fair value gap and using the fair value gap's beginning as a target, or if you're getting in from a break through the fair value gap, you can use 50% of the fair value gap for the complete closing of a fair value gap as the target. Okay, so this is very important to understand. This works to the upside, targeting bearish fair value gaps, or to the downside, targeting bullish fair value gaps, as you see on this particular play right here. Okay, so we had a failed 2 up right here, and then people, after this failed 2 up rejected off of this trend line, you saw people take puts, and look what it did. It came down to fill this fair value gap right here, which is also at an order block, and then it formed a reversal to head in the other direction. Okay, fair value gaps, liquidity, order blocks, they are all the same when it comes to targets, because it's at the edge of them or in the midst of them that a decision is being made. Okay, now an area of liquidity may be a trend line, right? So this is why I'm constantly drawing trend lines on on my stocks, right? Typically with liquidity, the market is trying to get people out of their stop losses. So this is why I stretch my trend lines beyond certain levels, right? I'll connect 2 points to draw the line, but I'll stretch them as far as possible so that we could see the points in which there may be some sort of decision being made. Okay, as you can see right here, if you would have taken the failed 2 down, up, you see that the level of liquidity was right here at the trend line, right? This was the high, right? So this is where a lot of people took profits. This is a great target to have when you see some sort of change of direction. Okay, so trend lines, fair value gaps, right? Trend lines can also act as an area of liquidity, and then order blocks, last but not least. Okay, order blocks are just simply made up of institutional buying, right? To make the definition that I gave a little bit earlier a lot simpler, it's just an area where institutions believe that the price is either too expensive or it's very affordable. Okay, so a bullish order block like right here would be an area right here where institutions are like, this is where I want to buy Microsoft. Something like this, right? This bearish area of an order block or bearish order block is where institutions believe that Microsoft in the short term is too expensive. All right, so they would be selling at this point. So if we break above this fair value gap right here and we make our way up, the first area of resistance would be the beginning of this fair value gap. But if it finds a way to make it through and fill these fair value gaps, then the next major resistance would be at this bearish order block. Okay, this is very important to understand. Not only does bearish order blocks and bullish order blocks provide you with great targets, they also serve as great entries, right? So by the time that this stock has, it's come down and then it makes its way back up here, it may be making a decision here at the bearish order block to then find its way over time back down to this bullish order block, creating what we would call a double bottom pattern. Okay, so by having these on your chart, not only do you understand when to get out, but you also understand the highest probability to get in. Now, I know that a lot of you have been taught to get into trades at certain levels. Like, I have a line drawn right here. Typically when you're new to trading, you'll draw just a straight line. And a lot of times you'll find yourself frustrated because once that line is breached, it's like, okay, well, what do I do next? And you're not understanding that typically the buying is taking place in an area and not just a flat line. The stock market is, it's more of an art than a science. So a lot of times there will be areas, right? Not just one specific number that institutions are looking for. And you may see some sort of reversal signal that fails. And then you finally get another reversal signal, which is what we call a delayed reaction. And then you'll get the confirmation candle wicking off of that, showing that it's okay to finally enter that trade. So these areas give you time to position yourself and then decide to get into the trade without risking it all at a single level. Okay, so it's very important to understand that. A couple of other rules of thumb is when you are close to a bearish or bullish order block, it is not smart to take trades in that direction because, again, the reversal can happen anywhere from the beginning to the top of that order block. So it's very important to wait for a reversal and then a confirmation inside of an order block to take entries. And by the time you've entered a trade and it's made its way back up to a fair value gap or an order block, start making a decision about getting out of that trade. Now, if you're trading with multiple contracts, the first target, if you have a fair value gap above the level that you enter and you're going bullish, the first target would be the start of that fair value gap. The second target could be either 50% of the fair value gap or a full filling of that fair value gap. And then the next target, once that fair value gap is clear, and final target would be up to the start of the next fair value gap. Okay? These are just pointers to give you an idea of where the stock majority of the time does move after it decides to go in that direction that you see the market structure going into. Okay? Now, sometimes, things do not pan out on the second or third day, so it's always important to also give yourself some time depending on the time frame in which you're looking at. So if I'm looking at the daily time frame, I'm typically going to give myself, a full week. So if it's even Tuesday or Wednesday, I'm looking to get something for next week. And if it's, toward the end of the week, I'm looking to get something maybe 2 weeks out, just to give myself some room for the stock to play out in the direction that we're thinking it's going to play out. Okay, so again, use the edge of order blocks and fair value gaps as places to enter and exit, right? And never take trades into the order block in the opposite direction of what that order block represents. So this order block represents bearish. Don't take calls into it. This order block represents bullish. Don't take puts into it. It just doesn't make sense. The likelihood of you being correct is a lot lower than you being correct just following the direction of the order block. So taking calls here and taking puts here would be way more high probability. All right. I hope that this is helpful for you guys. If you guys have any questions or need any sort of clarification, please be sure to drop those questions in the chat, okay, or in the comments. I know you guys hear the statistic all the time about 95% of traders losing money. Well, the reason that 95% of traders are losing money is because a lot of them are implementing and regurgitating the same age-old strategies, and they're not using the leverage of institutions to support their trades. It's called smart money. So being a smart trader means that you follow smart money. The institutions are usually going to determine the direction of the market because they have more resources, right? They have the ability to be able to push and move markets in a way that us as retail traders can't. So the way that we get the best advantage is just by making sure that we're siding with them. The way we side with them is the order blocks, is the fair value gaps, is the liquidity, okay? Again, I hope this video was helpful. Hit the subscribe button if it was and you don't want to miss any more valuable videos. Also, comment below a subject that you would like me to cover in the future. Okay? Remember, invest smart, live free. I'll see you in the next one. Peace.